Today's markets are still in the red as investors all around the world fear a looming recession. As Investopedia defines it, a recession is a significant, widespread, and prolonged downturn in economic activity. Recessions typically produce declines in economic output, consumer demand, and employment. As we hear news of employee layoffs from one major tech company to another, it is just reasonable for investors to take precautionary measures on making sure our investments survive the impact of a recession. On the bright side, historically speaking, stocks begin to bottom at the beginning of a recession and continue to recover as we weather through it. That is why we're here to give you our top 5 stock picks for companies that we think are recession-proof. Our goal is to help you on your journey to financial freedom so you can live life on your own terms. If you like this video, make sure to destroy the like and subscribe buttons so that you won't miss any of our future content. Make sure to stay till the end, as our last stock pick is our favorite, and we think you'll like it too. Now let's get right into the video. First off, we have Home Depot Inc., HD. The Home Depot Inc. is an American international home improvement retail company that distributes appliances, tools, construction supplies, and services. Home Depot is the largest retailer of home improvement products in the U.S. The corporation generated more than $151 billion in revenue and employed 490,600 people in 2021. With an Atlanta mailing address, the business had its main offices in Cobb County, Georgia, which is incorporated. It runs several big box retail outlets throughout the United States, as well as in the District of Columbia, Guam, Puerto Rico, and the U.S. Virgin Islands, all 10 of Canada's provinces, all 32 states in Mexico, and Mexico City. The Home Depot also owns the MRO Business Interline Brands, which has 70 distribution sites nationwide and is currently known as the Home Depot Pro. Prior to the COVID crash, its stock price was trading at around $245 a share. As the global markets tanked in March of 2020, Home Depot dropped 43% from this peak to $140 a share when the dust settled. The markets quickly realized that Home Depot's price crash was mainly irrational and that its operations remain solid as demand for essential goods and services still keeps up amid a pandemic. Its stock price surged by a whopping 190% from the bottom of the March 2020 crash to December 2021. Home Depot announced that, despite growing expenses and macroeconomic headwinds, its third quarter revenue climbed by about 6% to almost $38.9 billion, exceeding analyst estimates. In a conference call with investors, the retailer's management noted that both its professional and DIY sales increased during the period and that professionals report that their backlogs are still healthy. In comparison to the same quarter the previous year, the company's profit increased to $4.3 billion, or $4.24 per diluted share, from $4.1 billion, or $3.92 per share. Investors have been monitoring Home Depot's performance as well as consumer spending on DIY home improvements and renovations in the face of ongoing inflation. On a teleconference with investors, Home Depot CEO Ted Decker stated, "We're navigating a unique situation. We can't predict how the macroeconomics backdrop will affect customers going forward." However, he continued, the business is confident that demand will hold steady, particularly given that consumers are continuing to spend more time at home than usual. According to him, the ordinary Home Depot consumer can still afford home renovation projects. Looking into Home Depot's numbers, revenue has consistently grown through the years. From $74.7 billion in the year 2012, Home Depot has booked a whopping $151 billion 10 years later. Talk about more than 100% growth in revenue. What's more, its operating margin has increased from 12.7% in 2012 to 16.8% in 2021. Its return on invested capital has also significantly increased from 18.3% to 49% over the same period. That's an average of 33.7%. At its present share price and conservative earnings per share predictions of 5% annually, our model projects that Home Depot stock will have annual returns of 9.8% over the next 5 years. Next on our list is something truly familiar to us, and that is the Dollar General Corporation, DG. Dollar General Corporation is a discount retailer operating in the U.S. As of the 25th of February 2022, it had 18,190 locations across 47 states, with the greatest concentration of stores in the southern, southwestern, midwestern, and eastern regions of the country. It offers a broad selection of merchandise, including consumable items, seasonal items, home products, and apparel. If you'll zoom out, Dollar General's stock has been in an uptrend since 2017. However, the crash of March 2020 didn't spare Dollar General's stock from tumbling down. The stock has dropped 25% from its peak of around $165 a share to $125 a share, yet this is relatively better compared to the 35% drop of the entire S&P 500 over the same period. If you've perfectly timed the bottom in March 2020 and bought the dip, you would be sitting at a 100% gain to today's prices. Yet, despite the heavy losses other stockholders have with their current portfolios, Dollar General has outperformed the overall market. Dollar General recently opened its 100th pop-shelf store and said it's on track to operate approximately 1,000 total stores by the end of its 2025 fiscal year. Within Dollar General markets, 30 of the present sites are designated regions. By the end of 2022 fiscal year, the firm stated that it anticipates having roughly 150 standalone stores and 40 combination formats. While normal Dollar General stores are designed to appeal to customers earning $40,000 or less, the pop-shelf idea targets women with households making $50,000 to $125,000. The typical selection of goods comprises a cross-section of Dollar General's proprietary brands, seasonal specials, and limited edition items, as well as housewares, home decor, health and beauty products, toys, and electronics. This expansion can definitely aid in further revenue growth and new consumer acquisitions. Speaking of revenue, Dollar General has booked an average of $23.9 billion annually over the past decade, from $16 billion in 2012 to $34 billion in 2021. The steady growth of the company is mainly due to its competitive advantage in the space and its strong brand. Although its operating margin has tightened from 12% to 11% from 2012 to 2021 respectively, its return on invested capital has increased from 13% to 24% over the same period. Based on our conservative estimates, Dollar General can make an average return of 2.4% over the next 5 years. Next up, we have a company I'm sure has become a part of all of our shopping, and that is Walmart Inc., WMT. Walmart Inc. is the largest retail chain in the world, and it runs 6,101 overseas locations, the majority of which are in Latin America, along with 3,570 supercenters, including food departments, 374 discount stores, 599 Sam's Clubs, and 799 neighborhood markets in the United States. As of January 31st, 2022, 1.121 billion square feet are allocated for retail space. Most retailers are 400 miles or less from a distribution center, and most retail space is privately held. 56% of American sales were made up of groceries. In 2021, sales per square foot were roughly $500. Just like Dollar General, its stock has been in an uptrend since 2015. The stock only dropped 18% from its peak of $127 a share to around $104 a share during the March 2020 crash and quickly recovered as investors began to realize that the retailer benefits most from the panic buying that was happening back then. Its current price is sitting near its all-time high and is consolidating while the overall market awaits a trend reversal. Walmart experienced strong revenue growth across all international categories in the third quarter. And as a result of Q3's outstanding results, the retail juggernaut increased its full-year target for consolidated sales growth by 1%, currently anticipating an increase of about 5.5%. Despite exceeding projections and seeing robust sales growth, Walmart reported a $1.8 billion net loss for the third quarter. Let's look at the business's performance and see why the consumer staples stock is still a hold. Despite reporting a $1.8 billion loss compared to a $3.1 billion profit last year, CEO Doug McMillon said Q3 was a good quarter because of the increase in sales. McMillon is still confident in Walmart's capacity to meet members' and consumers' needs on a global scale. Indeed, according to Walmart, the company is experiencing growth in all areas of the business, including online sales, Sam's Club locations, and physical shops all over the world. Online sales are rising. They increased 16% between the second and third quarter of this year alone, accounting for 13% of Walmart's sales thus far in 2022. E-commerce increased 46% year over year when looking at it from a constant currency perspective, which removes the impact of currency exchange rates on sales data. Walmart aspires to return to profitability in the future by enhancing both its inventory and supply chain. Improved vendor sales agreements are one method for doing this in order to cut expenses and lessen the impact of inflation. Looking into Walmart's historical revenue, it booked an average of $507 billion over the past decade, from $470 billion in 2012 to a whopping $573 billion in 2021. Although its operating margin has tightened from 7.7% to 6.4% from 2012 to 2021, its return on invested capital has grown from 15.3% to 15.6%, with an average of 13.5% annually over the same period. Our model suggests that Walmart still has room for more growth, and our model conservatively estimates 12.5% annual returns over the next 5 years. Now we're down to our last two picks, which are some of our favorites. We have yet another familiar household brand, Target Corp TGT. Target Corp, Target, is a retailer of general merchandise and food products. Baby and beauty items, apparel, electronics, furniture, groceries, home and pet products, school and office supplies, shoes, sports and outdoor gear, toys, and sporting goods are all included in the company's product line. In addition, Target provides services including home delivery, photo printing, rewards, and gift cards, as well as optical, clinics, and other facilities. The business leases a variety of retail establishments, storage facilities, office space, distribution hubs, land, and machinery. Target sells goods under its own and proprietary brands. It runs its stores under the Target and Expect More names. Banners for Payless and the Bullseye design. The U.S. city of Minneapolis is home to Target's corporate headquarters. At the crash of 2020, Target's stock price plummeted 30% from its peak of $129 a share to around $90 a share, yet has fully recouped all these losses in just 5 months. Though the stock is sitting well above its pre-pandemic high, the stock is currently trading 33% below its previous high. Talk about a bargain at Target. In order to better serve its customers and team members and spur more growth, Target recently unveiled the next phase of its new retail strategy and store design. With approximately 150,000 square feet of area, Target's new larger format sites are more than 20,000 square feet bigger than the chain average. They also make better use of greater space and new design elements. The retailer will continue to open stores of all sizes, but in the coming years, it will put more of an emphasis on this bigger presence. Target will also apply its reinvented store design, which has a more open layout and localized components to serve and excite its customers, to upcoming remodels as well as new shops throughout the chain. Target leveraged years of research and learnings to create both the updated store design and evolve its store strategy to debut a newly expanded footprint. These larger locations will support Target's well-known same-day fulfillment services, provide customers with the wide range of goods it sells, and carry out its stores as hubs plan for digital fulfillment. The company will continue opening stores of different sizes to serve customers in communities across the country, as it has for years through its small format store strategy, even as it focuses on the new larger presence in the coming years. Looking into the numbers, Target's revenue grew from $73 billion in 2012 to $106 billion in 2021. Its operating margin has been steady at 9.5% on average per year, and the return on capital invested has grown from 10.5% to 26.1% over the same period. Everything looks good when we look at the stock valuation for Target. At its present share price and projected earnings per share growth of 18% annually, our model predicts that Target stock will have annual returns of 14.6% over the next 5 years. Last but definitely not least is one of our favorites, Procter & Gamble PG. William Procter and James Gamble formed the Procter & Gamble Company, P&G, an American international consumer goods firm with its headquarters in Cincinnati, Ohio, in 1837. It focuses on a broad range of consumer health, personal care, and hygiene items. These products are divided into numerous categories, including baby, feminine, and family care, beauty, grooming, and healthcare. Prior to the COVID crash, PG's stock price has risen 77% from its lows in May 2018. At a peak of $127 a share in March 2020, the stock tanked 25% at the height of the capitulation phase, yet has fully recovered 5 months after when the Fed stepped in to rescue the markets. Though its current stock price is hovering just above its pre-pandemic highs, the stock is still trading at a 15% discount relative to its previous peak at the start of the year. About an hour southeast of downtown Phoenix, Procter & Gamble Co. disclosed plans to erect a sizable fabric care manufacturing facility on more than 400 acres of land. The 2,700-acre inland Port Arizona in Coolidge, a sizable industrial park in the southern part of the city that currently houses Nikola Corp's production facility, is where the business said it intends to invest $500 million in the new factory. The company's fabric care portfolio, which includes goods including Tide Pods, Downy Unstoppables, and Bounce dryer sheets, will be supported by the new 2 million square foot facility. According to city documentation and marketing brochures, It will be situated on 432 acres along State Route 87 and the Union Pacific train line between Eureka, Shed, and Vale Roads just to the north of Nikola's factory. P&G stated that its facility aims to use the most cutting-edge, inventive, and sustainable production and supply chain technology. Based on the numbers we've gathered, PG has booked an average of $74 billion in revenue for the past 10 years. Although revenue has dropped from $84 billion in 2012 to $76 billion in 2021, its operating margin has significantly increased from 22.6% to 27.8% over the same period. That's an average of 25.1% over the past decade. What's more, the return on invested capital has grown from 13.8% to 21.6% over that same period. Our model suggests, given PG's expansion plans and good business economics, that it still has room for 4.3% annual returns over the next 5 years. There you have it, folks. Those are our top 5 stock picks that we think may fare well in the event of a global recession. Thank you very much for watching, and we hope you stay tuned as we have more exciting stock picks in store for you. If you have some personal stock picks, go ahead and comment them down below, and if you enjoyed our content, don't forget to hit the like and subscribe buttons, and we hope you have a truly amazing day ahead.